Hello, I'm Jake Elmhirst from the UBS Private Funds Group. I'm here to interview Steve Klinsky, who is the CEO of New Mountain Capital. Steve, first of all, perhaps you could start by telling me how your approach to private equity differs from the rest of the private equity industry. What are the key tenets of your business and how you make money?
Yeah, some other firms may be doing similar things, but what we do is really focus on business building rather than debt. So we buy 3 or 4 very carefully chosen companies every year, mid-market sized companies. We use debt very carefully and really try to build new mountains in the industries where we invest. And we haven't had to buy one company in a sealed bid auction since the firm began, because we generally go into a partnership with the sellers where they keep a piece and want a partner to build the business.
That approach has generated an exceptional record in terms of survival of your businesses and lack of losses. I think you've suffered no losses in the entire history of the firm, and maybe only a couple of companies held below cost at this point in time. If you think about the private equity industry as a whole, one of the criticisms is that the returns generated are not that much better than public equity markets, and when you factor in the effect of leverage, essentially private equity is just a leveraged beta play. How would you respond to that? Do you think that's an accurate or a criticism that holds merit?
I think that private equity makes a lot of sense for the institutional investors who have it, and I think they realize that. And the statistics I've seen is that even the average private equity fund has outperformed the S&P in the U.S. by I think about 500 basis points. 1, 3, 5, 10 I think are roughly the numbers. So there's been consistent outperformance even at the average level. And for the best funds, and obviously people try to be the best funds and invest with the best funds, I think the great advantage of private equity is you're not just passively gambling in a stock market. You actually own a business that you can change the management, change the strategy, transform it, and then therefore have the most control and the most predictability of earning very high returns uncorrelated to the stock market. So it's a totally different approach than being a passive investor in any index, and it's a skill-based business versus a passive business.
Now, you don't use a lot of debt, a lot of leverage on your businesses. Tell me why that's important and how that's lent itself to your strategy over time.
Yeah, we're not against debt. We'll use debt if it makes sense, but what we use it the way good corporate finance principles say to use it, not as a drug that we depend on to buy companies or achieve returns. So what we think about is we'll use as much debt as makes sense so long as we don't endanger the business and so long as we don't slow up the growth opportunities of the business. And the first thing is keep the business safe, achieve the growth plans, and if some debt then makes sense, we're happy to use it as a sweetener.
Do you think when you compare the returns of private equity versus public markets, there are inherent advantages through a private equity strategy that just aren't shared by public equity managers?
There's a tremendous advantage, and again, it gets back to the difference between being in control of a business where you are a business person building a business in comparison to being a passive investor. So to use an example, if you're at the roulette table, a passive investor is betting whether it's going to be red or black. If you own the roulette table, you can pick up the ball and put it in the right slot, and that's called management ability and operating ability. So you don't have to, all the kind of market studies are based on the idea that you're passive, and the whole idea of private equity is you own the business and you can build the business like any other business person.
So New Mountain is it's a diverse business. Your principal line of business is private equity, but you also have a public equity product, and you have a debt product as well.
Right.
How do you deploy your strategy or approach across those different products, given the advantages, the inherent advantages of private equity?
What we do is use our central skill sets as much as possible to be a better than normal public equity fund and a better than normal debt fund. And the way it applies is in public equity is, we do very, very deep industry research in private equity. We have operating capabilities. We have operating managers. So that gives you a deeper insight into industries than a normal stock market investor can have. Furthermore, whenever possible, we do try to work even though we're not in control, with the managers of the companies we invest in to improve their strategy, tell them what we would do if we were in their shoes, and we've had very positive impacts on these businesses, even though we don't control them, because we're actively engaged with the managers. So we can be as close to a private equity fund on the public equity side. On the debt side, what we've done is buy debt of the same companies that we thought about for private equity. If we thought they were safe, but someone else bought them, we could use all that research and buy the debt, and that's much more intensive research than a normal debt portfolio can do. And we've had also very low defaults in the debt fund.
So many private equity funds over the last few years have adjusted their approach, or the way they articulate their approach. Maybe in the early 90s, mid-90s, leverage was seen as being very important towards generating investment returns, much less so today, even though interest rates are at historic lows. But as you think about the rest of private equity moving more towards the approach which you've always taken, what sets apart a firm like yours, where your returns are clearly extremely strong, versus other firms? What are you doing differently?
Well, I think it wasn't even back to the mid-90s when people were talking about debt. I think if you go back to 2007 and 2008, it was the biggest debt bubble of all time, and firms were using debt in an excessively high way, and saying that was a virtue of what they were doing, and there were some mistakes made. So even if people change their speech and say they are now operationally focused, the key is to go behind the speech. And what you have to do to be successful at it is be consistent about it and have a team of people who have spent years and years proving their abilities to do that. So, we've been at it for 13 years. I've been at it myself for 32 years. And what we've been able to do is create 60 investment professionals to buy just 3 or 4 companies a year. And over 20 of them come from corporate and operating and management consulting type backgrounds mixed in. So you can't just say it, you have to actually live it and be referenceable and prove that you can do what you say you're going to do.
When you think about your own background, you were at Goldman, you worked with Ted Forsman, always in an investment role. I'm not sure if you were in a banking role before that at Goldman, but where did you pick up your operating expertise, and do you really feel as though you are somebody who truly holds operating credentials as opposed to finance credentials?
I think I hold private equity credentials, which is a world where what you do is buy and build businesses with a whole team of people. So I think the mentality that I'm speaking about comes from the fact that I grew up in a family business. A lot of the people in the firm grew up in family businesses. So the idea that companies are not poker hands where you fold, you win one hand and fold the other, I think is kind of bred into you growing up and realizing there's a group of people who work at these companies. So that's fundamental. And I do not hold myself out as individually a brilliant operator, but that's why we built a team of 60 people, including operators, finance people, a Pulitzer Prize winning investigative journalist, supply chain experts that collectively, as a firm, can add value to a mid-market company. So I couldn't do it on my own. I would never claim to do it on my own, but that what I have been able to do, I think, is build a team of 60 people to do it that together is pretty strong.
I think many of your LPs would acknowledge that probably the most important thing you bring to the table is your judgment, based on over 30 years of experience. How centralized is the decision-making process at your firm, and how critical is your personal judgment versus that of your colleagues?
We use the entire firm to make judgments, and we bring everybody together, and we don't make a judgment on one day, like a Supreme Court. We talk about these companies and these industries over and over again in a kind of an interactive way for months before we actually make a decision. And we want to get everyone's judgment at the firm to ask questions, throw challenges. And when it finally gets to the end of the process, I'm the last person to speak, so essentially my vote doesn't really even matter, because if the whole firm wants to do it, there's never been a case where I say no, I'm against it, and nor when everybody's against it, I say we're going to do it anyways. So what happens is it's a collective thought process driven for sometimes weeks or months, and that's what leads to more wisdom than one person could have.
If you think about the public image of private equity today, how do you think private equity is perceived, and do you think it's a fair perception, and what do you think needs to change if that perception isn't fair?
Yeah, I think the private equity perception could be very much improved, and I worry that it is not very good. I'm not sure. I've never done polls myself, but I always think people think Danny DeVito is going to come in like the character in Other People's Money and sell someone's desk. And so, for example, what we do at our own firm is ever since 2008, we've published a social dashboard on our website for anyone to read, where we explain we've added or created over 10,000 jobs net of any job losses. We spent $1.4 billion in R&D and software development at CapEx. We've never had a bankruptcy. We've never missed an interest payment. We pay far above the average wage because these are high growth, high margin companies that we own. And so to the extent that private equity people explain the successes that they're creating at the companies they own, I think they could improve the perception that this is not just leverage or investment banking or somehow passive stock market investing. We actually own and build businesses, and that's the key thing to improve.
If you look at the alpha generation for private equity and how that alpha is shared between GP and LP, do you think that split is fair? Do you think it's likely to change in the next 3 to 5 years, and what will make that change?
Well, I think it's fair because it was agreed to through two very sophisticated parties, sophisticated LPs and a sophisticated GP. When it works, it's extremely valuable to both sides, where the LPs can get the best returns of anywhere in their portfolio, and the GPs are well compensated as well. So I do think it's been fair and proper, and it may change just through normal market mechanisms between the LPs and the GPs, but it's been that way for quite some time.
Steve, the structures that are used in private equity today have really grown up from the 1980s, but do you think there's any chance that those change, maybe in response to changes in taxation of carried interest, the emergence of potentially evergreen structures? How likely do you think that is?
I don't know how likely it is. I mean, the structures that exist are there for historical reasons, not necessarily because they're the absolute best theoretical structures. And Warren Buffett essentially does private equity transactions through his permanent vehicle. Others have created other types of vehicles, so it could change, but I don't know what the next stage would be, if any.
And final question before we wrap up. You have 4 kids and you have 3 different products: debt, public equity, and private equity. Where do you invest their money? Or where do they invest their money?
All 3. So we're working hard. I have 4 real children and 3 theoretical product children, and we're trying to take care of all of them. So they're in all. My kids are spread across all 3.
Right. Steve, thank you very much indeed for your time this morning. It's a pleasure talking to you.
Thank you very much.
Thank you.